what would you recommend someone who's completely new to investing in finance? How should they get started? How should they go about it?
So finance to me is more of a behavior and a psychology, right? And this is what I teach in most of my session. I don't tell them
Right.
where to invest. I tell them what to do and what not to do, right? So if you see most youngsters today, or we call them millennials, Gen Z, Gen Y, I don't know, right? So most of them don't believe in long-term investing, right? Most of them live for today compared to our past generation, our parents who used to save for the future, right?
Right.
They were mostly debt free, and the current generation survives on debt. So, what we need to do is one is introduce probably the financial education right at the school stage, where we
Absolutely.
teach people life skill about finance. We teach everything to people, we make them extremely brilliant, but we don't teach them life skills.
Yep.
Right? So, very, very important that we slowly and sooner than later introduce finance at schools. Second is tell them that it's more about behavior and psychology rather than it's a art or a science.
Absolutely.
Right? You have enough experts who will help them with managing the money, but for them it's important to get started.
Right.
So the power of saving, the power of investing, the power of compounding is what we need to tell them. If you can show that and get them through, I think we are done.
Right.
Right? There are enough people who will take care of what to do with the money. Important is to get into that discipline of saving and investing
Right.
and thinking long term.
Absolutely.
Right? Even with that little bit of money, if you are thinking long term, it can create enough wealth
Right.
for you to make it.
No, that I think that discipline point that you talked about is crucial, right? There's this very famous saying: "It's not timing the market;
It's
it's
about time in the market." Yes.
right? And I think most young people are yet to understand that
Yes.
because they haven't seen market cycles as a whole. But I think if I were to give one key takeaway to our audiences today, that would be just start small. But then just forget about that money once you invest it,
Yes.
and think like you're going to get this money, 10 years later, 20 years later, and then you'll see the magic of investing manifest itself. So this is actually pretty amazing in terms of inculcating that decision making. But if you were to just tell someone, okay, step one, step two, step three, this is what you need to do to start your first investment, what would you say to someone young?
The first thing I'll do is generally how do we define savings? We say income minus
Expenses.
expenses is savings. I just turn it around and I say income minus savings is your expense.
Absolutely. Save first.
Save first, right? So that there's another term for that. We call it pay yourself first.
Yeah.
So PYF, right? So when you get 100 rupees as a salary, pay yourself 20 rupees, and remaining 80 you manage your expenses, right?
Absolutely.
And to make sure that this happens, what I preach or I teach is automate this whole thing. So that there's no manual intervention where you have, okay, can I use 90 this month? Can I use 100 this month? I'll save next month. No, let's not do that. So start with whatever you are comfortable with. Start with 10 and then see if 10 is enough or you want to make it 20 or you want to make it 5. But
Right.
automate that so
Makes
that
sense.
you don't touch those 20. Right? So that's the easiest piece to do.
Yeah.
But yeah, very difficult to convince and get started. And once you start, I think the rest will follow.
Right. No, that makes complete sense. And like one of the most common questions that we get is, how do I get better at saving?
Yes.
So it's so psychological that it's literally splitting your money in a different bank account, and you just keeping it in mind that you're not going to touch that money. That's all you need to do essentially, right? Which is I think some great advice for someone who's just starting off. Now, for these young people, the first thing that they need to do is build up the savings in the bank account. But we obviously know that bank accounts don't give us enough interest, right? So what do you think is the first instrument that young people should consider as their first investment?
So I think most people today are influenced still by the previous generation, right? So our parents' generation, where the only instrument they know or like is FTs,
Yep.
real estate, and gold.
Yep.
Right, and most of our generation has been forced to buy these things, irrespective of where the industry is going. So the first, my advice to most of the people I teach or when I take my workshop is that start with index funds,
Right.
right, which are absolutely no-brainer. Costs are super low, and if not anything, you will earn what the index generates.
Right.
So you don't need to worry at all about that. Right. So that's the easiest one. Passive investment, you don't need to worry at all, and that's one thing you can get started with. Once you start gaining some confidence and start learning a little more, then you can start thinking of going in diversified funds on equity and mutual funds or whatever.
Right. That also makes complete sense. Starting off with a well-diversified
Yeah.
index fund, putting it on autopilot, so to say. But there's been a common, I would say, myth out there in the market, right? Which is stock market is gambling, right? And because of that, people are like, oh, if mutual funds are investing in stock market, is that gambling too, right? So how would you go about debunking this myth for someone young who's watching today?
So, if you take our history for last 50 years of a stock exchange, right, there is only one direction this has gone up, right? It has gone from 0 to today at 74,000, and the Nifty is at around 22,000,
Yeah.
right? So, there's only one way this has gone. Irrespective of all the ups and downs, all the cycles, all the events that we have seen in the last 20, 25 years. I myself have been here for 25 years now. And we have seen the dot-com bust, we have seen the banking scam, we have seen Harshad Mehta scam, we have seen Ketan Mehta scam. So we have seen all of that, and still we are at 22,000.
Yeah.
Right? So what we need to understand that it's a gambling if you go in and go out every day.
Every
If
day.
you're watching it
Short
every
term.
second day, if you take decisions based on the movements. Like you said, it's not about timing the market, it's about time in the market. And the history shows that if you are invested for more than 7 years, you will never make a loss.
Right.
If you are invested for more than 10 years, you will always make money. If you are invested for 20 years, you will make more than 10 to 12%.
Absolutely.
Right? So we need to tell people that the volatility, which is a gambling. So we are not here for punting, but we are here for investing.
True.
Be there for long, you will not lose money. And that's what mutual funds are. Second is mutual funds are diversified, so they take away the individual stock specific risk.
Yeah.
Right, so you have cushion in other stocks. Not everything will fall together. Not everything will rise together. Right.
Absolutely.
So it basically averages out your risk.
Right.
So these are the two things I generally teach people so that they are more convinced to invest in mutual funds, though the mutual funds invest in stocks.
Invest in stocks. No, that's a fantastic point, and I think diversification is key there, right? But I think one thing that most young people need to understand is how do stock prices increase in value, right? Because over time they don't just increase in value because there's higher demand. The fundamentals of the company are getting better.
Yes.
The profits are increasing, the revenues are increasing, so the actual value of the company is going up. So you're making real value and real money. Which is I think a concept that most people haven't been taught yet. And I think if more people understood this, it would not feel as much as a gamble. It would seem like a calculated risk that you're taking. So that's a crucial point that you talked about. Was your journey when you started off similar? Did you start off with index funds, or was it a different
Absolutely,
approach for you?
absolutely. So I started with pure index fund and very small amount, and probably in 3 years you started seeing the corpus build up.
Right.
Right, and also the returns start to show up. Even if it's not phenomenal, it starts to show up. And then in the meanwhile, I was educating myself. I went through certification, so I started looking at diversification, and then started getting into real estate, gold, direct stocks, and multitude of mutual funds.
Right.
Right. So it has been a long journey, but yes, the starting point was very simple, very small, with index funds.
Yeah, and I think one very crucial point that you mentioned was when you got started, you started seeing the value of it 3 years down the line, right? I see most retail investors that get started within the first 1 year, they start panicking if there's a market dip, right? So I think what would your advice be for those people who, the moment they see red on their portfolio, they start panicking and withdrawing their investments?
Yeah, so even this is what I also teach them or tell them in my sessions, that invest in stock market only what you can lose, afford to lose.
Right.
Or in spite of the dips or the reds, you can stay put.
Right.
Right. Then only you should venture there. Otherwise, stay out
Absolutely.
of it. Right.
True.
And this will give you returns in the long term. So you don't expect it today, tomorrow, day after.
Yeah.
But look at it at 5 years down the line, 7 years down the line.
Yeah, no, and I think one very important thing to what you said is diversification again.
Absolutely.
So if your portfolio dips by 10 to 20%, you've got to realize that it's about 50 stocks or 100 stocks in there, right? So it's not that all those 50 to 100 stocks are going to go bust, which is the most important thing that people need to know, which is the fear or fear mongering that comes in, right? Which is, oh no, I'm going to lose all my money, but that's very unlikely if you're investing in broadly diversified index funds.
Yeah, and other thing I keep telling people is stay away from these news channels or the media or those influencers, because everybody has a stake in what they're saying.
True.
It's not they're saying it for you.
Absolutely.
Second is, we are talking about personal finance. That means it's very personal to me. It's
Yeah.
unique to me. So nobody knows my unique situation.
Absolutely.
What you are giving is a generalized advice. It doesn't apply to everybody.
Everyone.
Right?
Totally
So
agree.
first thing that you should do is stay away from all these influencers and the news channels who are preaching whole day. If those guys were that brilliant, they would have made enough money not to talk on TV. Yeah. And same for all these influencers.
Right.
Right? And we have seen over the last couple of years how the influencers have been failing the investors,
Right.
And most of are the retail investors. So I pity them because these are the people who are very vulnerable.
Right.
Ideally, we should be enabling them to do something good, whereas they have been failed by these influencers.
Right.
So I
That's-
feel
that's a
I feel
massively
that's
important
like
point.
that's a big no-no for this industry.
This industry, right?
Especially for a country like India where the poverty is massive and we want to bring the people out of poverty.
Yep.
So we shouldn't be trying all this.
Right, absolutely. And I think there's one similarity that will actually help people understand this really well. Imagine medical field, right? Imagine if you got sick and you just took all your advice from Google.
Exactly.
You know what's going to happen,
Yes.
right? You do check on Google to do a sanity check, but then you do need to go to a doctor when it comes to
Absolutely.
personalized advice. So I think it's the same way in finance as well. If you want to check high level, just understand what is out there, but take it with a pinch of
Yes.
salt, right? And in your own situation, work with a financial advisor or do your own research, right? You have those two choices and two choices only.